Welcome back to Clearing Spotlight, where market meets clarity and institution navigate liquidity, risk, and infrastructure. Today, I'm very excited to share the spotlight with the one and only John Cahill, Chief Operating Officer for Asia at galaxydigital. John, it's great to have you today on Clearing Spotlight. How's things going?
Feel pretty good.
So can you share a little bit about yourself before we start? Because we heard that 4 years ago, you have made a significant pivot from the institution finance to now leading a firm dedicated to digital asset and the blockchain sectors. How has your background enabled you to effectively in your current role?
I retired from Goldman in 2020, right as the pandemic was kicking off.
Okay.
And I took some time out. And it wasn't until kind of mid-21 where I decided to come back to do something, and it was with Galaxy. I had been doing digital assets in my spare time during that time when I was out of markets, and it seemed like the right fit. In terms of how my experience has informed my role, I was quite unsure when we first got going how useful my experience, 20 years in traditional markets would be. But I got to say, it mapped almost one for one in terms of, not only usefulness, but a lot of the processes, a lot of the documentation, a lot of the risk-taking and risk management functions were very, very similar. And so it was quite a smooth and seamless transition. The company's evolved a lot over the years since I've been with them since 2021.
So from your perspective, what is a milestone currently like? Now you're building a lot of in Asia, right? So what do you think the market has achieved from an institutional perspective?
Well, I think there was existential risk to digital assets being relevant in markets. I think there were times, certainly in the last 4 years, where it felt like there was, the risk of the entire market going away. The evolution of the industry has really been one of institutional adoption. So it's been an adoption story forever, but the institutional adoption has raised the bar on how to operate. It's a function of de-risking. It's a function of abstraction away from the unique risks that having and dealing in bearer assets has. And I see that continuing as more people like me with backgrounds like mine enter the space, and more institutions have these things on the balance sheet. We're in a cycle now where DATs are very prevalent. Have regular equity investors having access to crypto assets in their brokerage account, which didn't exist 4 years ago. So the evolution has been extreme, and more we're seeing the institutionalization of the space.
So currently, do you know any very good steps we have achieved for the segregation fund and handling the counterparty risk? Do you think it's efficient for traditional finance clients coming into the space?
You almost have to bucket institutions into different pieces. There are more crypto native institutions, which are just large pools of capital. We are one of those. And so we're quite comfortable with the construct. We spend a lot of time on counterparty risk. That's exchanges, that's customers. Anyone who's onboarded at Galaxy will know it's not a straightforward process and not a seamless and quick process. But we do that diligence up front in order to prevent dealing with bad actors and to really, I would say preserve, the kind of risk management style that we want. It's how we've been able to navigate through these, turbulent markets.
Based on your experience with balance sheet optimization, how is extreme volatility currently managed and modeled within the institution crypto risk limits?
Look, there's lots of companies that help as service providers in the industry, and we certainly contracted a number of those. A lot of the systems that we use at Galaxy are built in-house and are internal, and we're constantly getting better. Every time there's a new event or there's, a new risk vector that there's an exploit on, we get a little bit smarter and we get a little bit better and we iterate towards more safety. One notable thing post-FTX is that there was this big push for central exchanges to be more transparent about where assets were held and do proof of reserves and all this stuff. That lasted about 3 months. And then everyone kind of went back to business as usual without paying as much credence to that. We've been at the forefront of helping, de-risk exchange risk. And so that happens when you have things like tri-party arrangements. And more banks, more and more traditional banks are getting involved in that space as one of the three legs of the tri-party arrangement.
Given Galaxy Digital's trading volumes, our current on-chain liquidity level is sufficient to support major new institution entrants without slippage.
One thing crypto has is no shortage of liquidity, especially if you're talking about majors. And we deal mostly in majors. We have a big long tail of assets that we'll trade, but we're mainly dealing every day in Bitcoin, Ethereum, Solana, and the top, call it 50 coins. There's no shortage of liquidity to do large size. We had the privilege of executing an 80,000 Bitcoin trade in the summer. I think it was the largest single transaction ever done by a single counterpart. And we did that quite seamlessly over the course of, call it 7 to 10 days with very little market impact.
This is a very interesting question. So remember the incidents happened in October 10th and 11th. The settlement is certainly a very important thing as liquidity, as the clearing counterparties. Do you think from the traditional perspective, for this kind of events like this, is there any things you think in the future, how the institution can handle this kind of incidents and what we can improve the industry?
I think over-reliance on central exchanges is probably going to continue to be a challenge. And so if you rely on your execution venue to do custody, to do financing, and fully wrap themselves around the entire part of the process and ownership, I think that continues to be a challenge that real institutions, and this is banks and sovereign wealth funds, and endowments, I think they're going to have a hard time getting comfortable with that level of risk. I think that's one of the reasons that we exist as a company is we are taking some of those risks. We spend a lot of time de-risking those interactions, and then we're aggregating a lot of the liquidity ourselves, and that's why we have customers that come to us. They don't want to necessarily deal with an exchange or with a DeFi protocol, but they'll come to us and we can aggregate that liquidity and pass it through to customers.
Do you think that things like that will happen again in the future?
Look, I think as long as the risk exists and there isn't a construct to de-risk, call it centralized exchange risk, we'll have incidents, right? And I think how the industry deals with those over time is to move to a less all-encompassing model where parts of the stack are broken up and done by experts and kind of run independently.
About the execution side of things, I'm always wondering, because the rules say where you trade, but how you trade. That's where the real world game is. What specific non-pricing benefits does sophisticated OTC venues execution offer over typical listed exchange execution?
It's the counterparty risk, right? We're aggregating liquidity and providing a price to a customer. They don't have to go and face all the different exchanges with whatever's going on there. I think that's a huge benefit to dealing with an OTC provider that's hard to get away from anytime soon. And I think for larger institutions that have big flows and lots of sensitivity to headline risk, dealing with an OTC provider is a much easier, more efficient way to deal with that.
Yeah, so in the traditional market, we know that OTC actually contribute a lot of volumes, right? In the crypto market, we still see there's liquidity over different venues. We have SEX, we have DEX, and we have OTC DEX, and you name it. So liquidity is scattered around. Unlike other markets, there is a relatively no inner broker-dealer hedging activity in crypto. How do you think that market gonna evolve?
One of the functions we perform as being this, listed company, institutional first provider and with high operating standards, we want to be that wholesale market layer. And so we're working with lots of other dealers. We're working with centralized exchanges to create more of a wholesale market. So there is actually more activity between dealers. And look, we're liquidity providers to exchanges here in Hong Kong, like OSL, like Hashkey. And so we're happy to do that. That's the role of the wholesale market. We're doing that on the borrowing and lending side. Yeah. We're doing that on the spot side for execution. Yeah. We continue to see ourselves as important to help driving that forward for the markets. We need willing participants to come along for that ride, but it's part of our story that we're really trying to build this wholesale layer to the market.
Because we know that you are managing a lot of large block trades, right? So as you see in the increased institution relevancy in non-disclosed trading mechanism. So for example, there is a few ECN providers and there are some centralized exchanges that are providing so-called private rooms or like dark rooms. What do you think of that? Do you think that will be very popular? Will be more institutional using that?
Well, I think that there's still a lot of experimentation that's going on now. I don't think there's any clear direction of travel or winners in the space. But look, those are functions of the traditional markets. The FX market, behaves that way. So I can see that continuing to grow. And look, people want to interact with venues in a structure that they are comfortable with and have in their existing business. And as they do more in digital assets, I can see a familiarity being useful in attracting more liquidity to those venues. I wouldn't say there's any clear answer now on whether they are, taking a big piece of market share. We don't see that in our activities, but I think there's room for a lot of that.
I want to talk about a little bit about clearing and the settlement side of things. So we heard there are a few players that are building the CCP model, which is a qualified central counterparty model. In the traditional finance sector, it's very common, right? In the crypto world, people have controversial opinions about it. Some people think it's actually working, we need that, or some people think we cannot achieve that because the market fundamental probably different. So what's your perspective on that?
Look, crypto grew from retail. Retail is happy to trade on a single exchange. They're happy to take the counterparty risk generally. Institutions don't have that same frame, and I think it's probably only controversial because people who came with one mindset into crypto and wow, these protections and these structures don't exist in crypto the way they did in the old system. So there's a bit of a push to move that direction. I don't think it's a foregone conclusion that will be the ultimate endpoint for the market. Like I said before, there's a lot of experimentation. I think that's good for the market. And then liquidity will go where it goes based on where liquidity is. Liquidity begets liquidity is a thing you often hear. And if centralized, clearing becomes the default mechanism where most of the liquidity goes, then that will be a big significant winner. I don't think it's in evidence that that's a foregone conclusion at this point. We'll see. We're not trying to pick a winner. We're kind of up and involved in a lot of different programs. And I think that's what we're going to continue to do.
Do you think the on-chain clearing will be a solution for that?
Yeah, I think that's potential. There's a lot of work that needs to be done on de-risking everything DeFi. And I think there's still a lot of concern around bad actor participation, terrorist financing. I did a session 2 weeks ago with a bunch of private bankers from UBS. And they did like a word cloud at the beginning of the session. Yeah. And we were talking about stablecoins. And so they said, okay, when you hear stablecoin, what do you think of? What's one of the words you think of? And these are not crypto natives. And the biggest one right in the front was fraud, number one. And I thought, okay, well, that's kind of interesting.
Okay.
But I think that's where, that's where the mainstream market still is. And we spend so much time around crypto people talking about crypto things. And we just accept all these things as being fact, that crypto's come a long way, which is true. But I think the market at large has a long way to go for trust, has a long way to go for resilience. And looking at crypto markets in the way that crypto's developing them, I think they're still a long way off from getting their heads around it.
What are the biggest current weaknesses in crypto post-trade settlement infrastructure regarding to the concept of finality?
Post-trade settlement is getting addressed by doing things off exchange. And so this is kind of what the tri-party arrangement I was talking about before. You park some assets in a bank, the assets get reflected on exchange, and then you kind of do all your machinations with your collateral being protected in a bankruptcy remote construct. So I think that's one way. No one's really doing that at scale across enough venues for it to be the market leader. But I think directionally, that's certainly where the markets are heading for settlements.
What specifically operational measures are institution participants adopting to mitigate the direct counterparty credit risk in bilateral OTC deals?
Yeah, I mean, for us, it's just de-risking our counterparty risk and exchange risk. And that comes through the tri-party arrangement and getting guarantees on any assets that we have on exchange.
Recently, people talk about a lot of U.S. developments. What is their attitude? What is the new policy going to come in the near future? So this might be controversial, but open to ideas. What do you think of that?
I think context is important. And I think we went through 4 years of the Biden administration that was, frankly, unfriendly to crypto. And they kept reasserting that all the rules and regulations that were required were already in place, and that there weren't new regulations required, that you talk to a lawyer and you pay him a bunch of money and then you can go and do whatever you want. I think all the while kind of undermining the industry in the process. I think that the Trump administration has brought in a very different perspective, and my joke is that they've decriminalized crypto. And so I think experimentation is encouraged, not discouraged. I think that as long as there are not explicit rules forbidding something, then experimentation is possible. And I think with the passage of the Genius Act and Clarity coming, I think that it's put pressure on regulators around the world to have an approach that's a little bit more rulemaking forward and a little bit more clear in how they're creating the rules. I think they need, so the U.S. has the stablecoin legislation. Hong Kong recently had its stablecoin legislation pushed through. There's a bunch of projects in the queue now to get that rolled out. But I think you can't ignore crypto markets anymore. You can't just rely on old frameworks to regulate this industry. And so I think this is a huge opportunity to take a leap forward for the industry. There are other programs around the world for different jurisdictions, but the U.S. is the biggest, deepest capital market. It's going to be a leader, and I think they give cover to every jurisdiction around the world to be a little bit more forthright about rulemaking and doing it relatively quickly, because the U.S. is acting very quickly. Yeah.
So for a lot of institutions, either they step away from the U.S. market, or they are very deep in the U.S. market. So, but there are more conversations. I talked to a lot of partners. They are considering making a plan for entering U.S. markets. So you are the expert. Can you maybe give some thoughts on that? Is it a good timing for them to enter? Is there any opportunity for them right now? Or you see more like uncertainty, or some suggestions on that?
Oh, look, I think it's never been a better time to be in the U.S. It is the biggest, deepest, broadest, widest capital market. And I think there's been a huge magnet into the U.S. for builders, for people who are in this space. So I think we're already seeing that transition happen. But I also think the U.S. gets comfortable with a regulated perimeter. The rest of the world benefits from this also. And so this is good for crypto around the world. I think stablecoin adoption in the U.S. is a really interesting thing to watch. I think there's this idea of dollarization happening through crypto markets and through stablecoins. And I think there's going to be a response from other regulated jurisdictions around the world, because they don't want to lose the sovereignty of their currency, and they want to be relevant in the global stage. And I think the failure to act quickly is potentially troublesome for non-dollar currencies.
And you spent more than 20 years in Asia, right? So if we're talking about, let's say, Asia market, so which country you think is more proactive in the crypto side of things and building regulations forward, or what do you think about the most important markets in Asia?
I'm partial to Hong Kong, having lived here for a long time. I think Hong Kong is doing a very good job identifying the issues, saying where they want to be in the world. They want to, they're saying we want to be a hub for innovation. We want to be a hub for Web3. That's good. That has to translate into actual rules and regulations. And so these things are happening. So Hong Kong, I think, is doing a good job with engagement of the market. It's a bit slow in terms of implementing these changes, but these changes also take time. And so, I kind of get that. Hong Kong was the birthplace of a lot of the biggest centralized exchanges on the planet. And a lot of the activity in the early days of crypto was here. Now a lot of that has migrated to places like Singapore, I think more recently Dubai. But Hong Kong is very much in the center of the foundation of these markets. So I think Hong Kong is doing a good job. Singapore is a little bit less interested, I think, in having speculation onshore, and I would say probably not one to watch on the forefront. I think it's been a very supportive place for builders to build companies and for operators to run them. But I think less so these days. Australia just came out with rules last week that brings crypto into the financial services framework. And so there'll be a lot going on to watch there. Japan and Korea are also really interesting markets. A lot of crypto holders. Korea in particular has a very deep penetration of crypto participants. They've been on an institutionalized journey this year. And we're still waiting for the finality of rules around stablecoins, around corporates participating in crypto. And then lastly, Japan is slow. They were fast early, and then kind of went in a somewhat of a freeze for several years. But now they're finally making adjustments to the tax code. You'll see ETFs there. That might be a longer term event, but I think there'll be plenty to do in Japan as well.
How about Southeast Asia?
I don't have a great hold on in terms of the regulatory side in Southeast Asia. We're, I would say, underexposed to clients and customers there, but it's certainly a huge number of people and participants in crypto, and definitely an area where I think there's going to be a lot of growth. But I think it'll be informed by a lot of things that are happening elsewhere in the region.
Yeah, recently, definitely, I think a lot of news are coming from the Korea side. They're opening up for the institution. Do you think it will be like generally happen or happen very quick because they already have a good foundation for crypto? People love like crypto trading there. With the institutional adoption, the market will be more open. What is the speed for the market development?
I think the market will develop quickly. I think that the operating standards need to be raised when you're talking about like a pension plan, investing money on behalf of their participants. And so I think that will happen relatively quickly. There'll be a big, investment boom to create these companies or to enhance the companies that are existing now, to raise the bar for how to operate a company.
Yeah. So what is the next steps for the company-wise, or what is the main focus you want to achieve right now?
So Galaxy has two main parts of our business. One is this data center business that we have out in West Texas, and there's a huge amount of focus on executing that strategy to become one of the biggest providers of compute on the planet. So that's one major part of our company. The digital assets part of our company, we're going to continue to grow in every vertical that we've got. So that's markets, that's being a bigger OTC provider to more counterparts in spot, derivatives, borrowing and lending. It's advising more clients in our banking franchise. As markets consolidate and expand, as capital needs continue to drive activity, we want to be advisor. We want to be trusted advisor, financial advisor to as many companies as we can, especially the larger transactions. In our asset management business, as appetite for digital asset exposure grows and becomes more institutional, we want to be the provider of product that people want. And so we're offering differentiated product at competitive pricing to attract as much capital into the space. And we think we're pretty good at managing risk. We think we have pretty good access to differentiated opportunities. And that's where we want to be on the asset management side. Running infrastructure, we run validators across a whole bunch of nodes. We want to continue to lean into that opportunity to support the ecosystems that we are living in and operating in, and grow our assets under supervision in that space. So there isn't really an area of specific focus, but it's really growing the breadth of what we do and deepening our relationships with clients. And as more institutions come on board, helping be an educator and then an executor and an advisor in those strategies.
Thank you. Thank you for that sharing. So as we coming to the near end of the conversation, so I have a challenge for you, John.
Okay.
So without any further explanation, describe in 3 words the future state of crypto markets.
Abstraction, ubiquity, I have to think of a third word, and future. I mean, I think I use those words because for more institutional adoption and more adoption for everyday users, you need to be abstracted from some of the risks that crypto has. You click on a wrong link and your wallet's emptied. That needs to go away. My dad's never going to use crypto natively ever. So there needs to be an abstraction layer for that to happen. Ubiquity, because I think, digital assets will be pervasive in every aspect of life. I think, our banking transactions that we do today will eventually be on chain. I think blockchain technology is a great plumbing system for financial services. And so it will be everywhere. And we won't be talking about digital assets or real world assets. They're just assets. They're just functions that happen through blockchain. And future, because I think it's not today, but I think it's coming in the near future.
It was really, really interesting conversation today with you, John. So I'm sure that the viewers and the listeners would agree to that. Again, thank you for joining today for this episode. And we are still hoping to have you to gear up for our next session. Whenever the market moves, we will be here keeping things clear. You have been listening to Clearing Spotlight. Bring market clarity to light.